Manish, the extraordinary strength in the market continues. For how long it will
Hi,
continue?
Nikunj. So, there seems to be some sort of a bull fatigue setting in the markets, but given the liquidity position, I think that all declines or dips in the markets will be bought into. So, from that perspective, I think, whatever tinkering is being done by regulators to curb excessive speculation in the FNO and removal of a large number of scripts to be admitted as collateral as margin. These would all point towards strengthening the system, and I think that's the way it should be in terms of the health of the market. But as long as the SIP flows and all these technical parameters don't impact the SIP flows, which ran at something like 21,000 crores last month. If that happens, then obviously, you'll have an inherent strength in the bull market that we are in. And from that point of view, I think there is enough steam in the markets for the next 2, 3 years at least. And obviously, you'll have ups and downs, but I think the next guiding factor would be your upcoming union budget.
That's exactly, Manish. Hi, morning. Firstly, was going to be my next question. What is the market anticipating from the budget this time?
So first and foremost, realistic expectations on the real GDP growth translating into revenue growth, which will be reasonable. I think FRBM targets and some stiff targets to be set for FY26. For FY25, we are working with 5.8%. I hope this glide path to lower down sharply to around 5.1% in the next 1 year. If that happens, plus you have impetus on balance sheet expenditure of the government to accelerate infra spending, and at the same time be pragmatic on the pain that is there in the middle class and the rural folks to dole out something as consumption expenditure. You could have. You already have a lot of food subsidies that have been given, but something on the fertilizer front or on the housing side and all of those. And for urban Indians, by and large, middle class, if there was not to be too much of tinkering in direct taxes, that would alleviate a lot of pain, and some additional allowances on the personal income tax, the plus rationalization of GST on a few items which are considered prohibitive in the current scheme of things, because most of them under the 28%, are daily expenditure, or let's say personal expenditure item for the middle class. So those could be done away with, and counterbalancing that with, let's say, capital receipt, miscellaneous capital receipts, and so on. So I would broadly look at these things, balancing the FRBM and be pragmatic both on the capital expenditure as well as the revenue expenditures.
Great to talk about India, but the grain of the truth here is that global markets are also in a fine fettle. And given that we've got elections in Europe and then you've got big election in US towards the second half of this year now, that is something which in a sense could add that extra dimension of volatility. So how do you see the global election cycle impacting global markets, which also have been quite strong and supportive?
So I think the global setup doesn't seem to go away in a hurry. You already have the verdict come out from United Kingdom, France, and later in November you'll have the US. Uh, I think the big takeaway from the developed markets would not be that much political, but really doesn't make too much of a difference as far as India is concerned, whether Biden comes or Trump comes, but more so on account of the rate cuts. And now there has been increased clamor for rate cuts in the US. If that was to happen, then obviously it's going to be good for emerging market as a whole. So domestic factors would play a larger role, I would believe, and global factors. The big thing to watch out for would be, as far as India is concerned, would be the Federal Reserve cuts. rather than anything significant or earth-shattering. I mean, there can be geopolitical risk. I mean, nobody has a clue about that. But if we were to maintain current geopolitical status, I think elections, by and large, would be a non-event as far as India is concerned. See, volatility and risk are two different things. They can be volatility, but as long as fundamentals are okay, we should be fine, I would believe.
Unlike last earnings season, this time expectations from the earnings season are high. FMCG has reversed, monsoons are strong, inflation is behind us. So, do you think the risk for the market in the near term is that prices are high, expectations are high, and corporate earnings may not match up?
Corporate earnings, we are going into the earnings season with very muted earning expectations. So, broadly Nifty would be 0 to 5% sort of growth. But the margin tailwind, as we seen in the third quarter of last year and the fourth quarter, is abating. And if you were to exclude, let's say, the oil sector, the oil marketing companies, Nifty would broadly project 5 to 10% sort of a growth. So broader markets broadly should see, corporate India as a whole should see anywhere between 0 and 5%. And because bulk of them are basically by large companies, the bulk of the profit growth, uh, all caps and small mid caps really don't add too much to the corporate profit growth as such. And Nifty should be in the vicinity of 5 to 10% this quarter. So we're entering the earnings season with that sort of an expectation. Some of the sectors which, as usual, are likely to do much better than the others would be your uh, obviously BFSI, which is quite undervalued, as well as the earnings would be likely be better than most of the other sectors. You would have automobile, which will be actually leading from the front. You'll have a pharma sector, you'll have a capital goods, you'll have real estate, you'll have metals. These are some of the sectors which are likely to be doing much better than the overall corporate India earnings growth average. However, valuations, today markets are mindful of valuations. I mean, markets, if you see the construct and the structure of the markets today, they have gone into a defensive mode because, we have seen a sharp run up. There seems to be some sort of bull fatigue setting in. So, it's time for those sectors which have run up too soon, too fast, time to consolidate. And that is why you've seen the defensives likely come out in the open and started to move up. But having said that, I think some of the spaces which still have value is obviously BFSI or PSU pack as a whole, and obviously budget will have a lot to announce in that space. The metals, oil, power. These are some of the sectors, and a few of them in the power sector, not all of them would have some semblance of rationality as far as valuation. So today the problem is valuations. I think earnings won't be too different from what the expectations are currently that the market would be looking at.
So, any other tactical change that you see happening in the market right now, Manish, in the very near term, other than a bit of a prop up in FMCG?
So I think one is scouting for where is the valuation comfort. Because India is in a growth story. All of that is good for the medium long term, all well known. But I think the spaces that you have comfort is at BFSI. I mean, that is one space where earnings over the last 5 years has been stupendous, 35%, but the market cap increase has been roughly around 18 to 19% sort of. So there is clearly a out of sync, so to speak. Other than that, most of the other sectors would be trading at you know more than average 10-year evaluation. One space where there's always a divided opinion is the PSU space as well. I would think there is value because in these sort of overheated markets, you have some semblance of valuation comfort out there. Uh, some of the beaten down sectors which have not seen that bigger growth in market cap is the pharma space, which has not got re-rated. And obviously, this is one space which is out of sync as far as the growth and the valuations outlook for the next 3 years is concerned. So, other than that, I think broadly the growth is priced in. And it is not about buying high and selling higher. That comes more within uh, the realm of speculation or trading, but buying where there's margin of safety. So these would be some of the spaces where I, as a manager, would be comfortable.
You bought into stocks like Zomato, you were bullish on consumer tech and fintech. That space, which was a bombed out space, let's say a year and a half ago, 2 years ago, now has regained all the lost traction with the exception of Paytm, which is a special situation stock. How do you see this entire consumer tech and fintech space evolving from here now?
See, this whole consumer fintech, anything to do with tech enabled is basically a network effect business where the leader takes all. So obviously, these players, incumbent players, would have reaped the benefit of being an early mover. But obviously, when you are seeing success and you start to see competition come through. So I think all platform businesses have that leeway for them. The environment keeps on changing. Obviously, Michael Porter's five forces model, you'll have competition come in. Once you start to make profits, there'll be emulation of your own business models, so on and so forth. So one should be mindful of the competition, but otherwise the growth trajectory, because you have a platform business, not so much in the fintech space, but more so in the consumer tech space. It's basically a right to win, and a new players will have a tough time getting the business models in place because these are all unit economics business, and it's not easy to get unit economics in consumer tech very easily. And once you have achieved it, there's a non-linearity. So from that point of view, I still maintain for the next 5 years, platform businesses are going to have a disproportionate benefit because it's a growth story in India. And if you get it right early, then you have the whole, up move in front of you.
Manish, great to have you on the show. Thank you so much for taking the time out and speaking with us today.
If you like this video, then like, share and subscribe to ET Now.